All right. Hello, welcome. I'm Zach Howard, real estate in St. John's, Newfoundland, Canada. Welcome to my YouTube channel where I try to take a global macro look through capital markets, how that flows back to real estate and real estate pricing, asset as a purchasing power, protection in this fiat money debasement world. So I want to give you some overview of what I'm looking at here today to start Q2 2024 in terms of global markets. We have gold breaking out to all-time highs in all major currencies, $2,300 an ounce US, which is really signaling some kind of fiat money debasement accelerating, global political chaos. We don't know, but I want to run through some stuff that I'm looking at here currently. So on Monday of this week, April 1st, we had ISM manufacturing data come out of the US that sparked first increase after 17 months of continuous decline. So that ISM PMI data is from a diffusion index readings. And the way these diffusion index work is readings above 50 indicate positive expansion, below 50 contraction in said categories. We had ISM new orders break out 51.4, much higher than consensus and the previous month. That ISM 50.3, like I say, big breakout. The ISM manufacturing in the US has been in contraction the longest since 1981, even longer than the GFC of 2008, believe it or not. So arguably, the US was also in a manufacturing industrial recession in 2023, uh, despite what traditional economists want to bear. But the real story is where are we going forward? Manufacturing prices are accelerating, big increase month over month, and from the previous, and then from the expectation. And that's really largely extent of loosening financial conditions, that money flowing throughout the economy, uh, corporations, the larger corporations that is, and the larger wealthy in the economy, the haves and the have-nots. The haves are really doing a lot better with this higher rate backdrop. They're getting paid on their cash holdings, the paper wealth, massive increases since the Fed, the central bank in the U.S. really kind of pivoted from its hockey stance in November meeting. We've seen an increase of 13.5 trillion through those U.S. equity indexes, through those mega cap stocks, and the U.S. bond market. So this loosening of financial conditions is all a backdrop for higher inflation for longer, and it flows through the Western world, if you ask me. Uh, PCE, the consumer personal expenditure readings last week, they also saw increases, accelerations, and you look at it from an annualized basis, it's going in the wrong direction after coming down. So this is the Fed's core measure, if they're doing their job or not, which they state has to be at this 2% goal. Um, if they were coaching a professional sports team, they would have continuous losses. They're not meeting that goal, yet they have not been fired and don't seem to be wanting to get to that goal anytime soon and let this play out. Really looking at inflation through the lens of someone who was gaining weight. If they were 200 pounds back in 2020, 20 pounds a year, they jump up to 260, and now they only jump to 265. We're still going in the wrong direction from where the baseline started, and that's where the inflation situation is in the US and in the Western world. It's cumulative. It's where you start and where you're to today that matters. And inflation expectations are now reaccelerating after a pullback, most recently, the end 2023. Now the market is expecting this trend to continue. Tailwinds for that are definitely higher energy prices. We have WTI oil breaking out to $85 a day here April 2nd. Brent crude touching $89 a barrel. So Middle East tensions heating up. But really, it has a lot to do with the global economy just rebounding off some of its previous lows we've seen in 2023. Looking back for a second here through the 70s, we had a similar dynamic play out where we had a run up in inflation, pull back, and then in the latter part of that decade it's reaccelerated again. And I think we're going to get a similar situation play out in North America, Canada, and the US in the half of these 2020s. Because the fiscal impulse of politicians is to continue to spend. And when they continue to spend, they continue to debase the currency, the fiat money, which has infinite ability to supply to the financial system. Because there's nothing anchoring it like it was back in the 70s when it was anchored to gold. That's long gone. So there's nothing really keeping these politicians, the central bankers, accountable for the money creation. But back to the global industrial recession that we couldn't make the argument was 2023, now reaccelerating here in 2024. China, the second biggest economy, had a great, not a great, but a bottom beat last week off its low. So it seems to be reaccelerating here now on its PMI, back into expansion territory above 50. Big consumption user of commodities, oil, etc. So now you're going to expect increased demand to pick up in China, and globally, you're going to increase need for those commodities that are essential to keep the world going. Energy sector has not been a love sector for capital for the last number of years. While the high flying tech stocks get all the love and all the capital, the real value in terms of keeping the global economy moving day to day, you haven't seen capital flow back into that sector and be reinvested. So I'm pretty bullish at the oil sector. I live in a oil dominant province in Newfoundland and Labrador, and we have not been out there cheerleading the opportunities we have as a province or a country like we should be. One of the names here in Newfoundland that's quite essential for revenue and employment is Cenovus Energy. They look like a great company in terms of its long useful life of assets, WTI break even less than $40 a barrel, exceptional balance sheet, good cash flows, and I think they have a lot of runway ahead, especially in this backdrop of higher oil if global growth accelerates. The U.S. shale oil has really taken market share from OPEC Plus over the last couple of years, largely to do with Asia and EU buying more of that product. The issue there is the EU is really a big consumer of diesel product, and the shale oil out of the US can't be really run through a lot of refineries that produce diesel. So there's some constraints there, and I think there's opportunity on the refinery side as a result. Valero Energy and Phillips 66, interesting names to take a look at if you're looking at something in that space. The agricultural sector, DBA is an ETF for agriculture. It has seen a run up with other commodities here in the last couple of months, with this backdrop of weakening fiat currencies in relation to hard assets. So DBA breaking out alongside oil. Current uptrends. Daily, I do a notebook, and I kind of track global markets in terms of what spaces are uptrends bullish, downtrends bearish. You get the major U.S. indexes are all showing bullish territory currently. Bitcoin has been bullish here for the last couple of months since the introduction of the spot ETFs. Those mega cap 6 stocks getting all the love. Gold, Bitcoin miners, oil, copper, silver, uranium commodities all breaking out higher in the bullish trend. The US dollar really is showing a strength off the back of a weaker euro and a weaker yen. So if you're unfamiliar with the way the DXY, the dollar weighted index component works, its biggest weightings are euro and yen. So weaker currencies there strengthens the US dollar in relation to that. But I'm looking to look through currencies in relation to hard assets, commodities, gold, even Bitcoin, etc. Japan, its currency, the yen continues to weaken. As a result, its stock market, like the US stock market, continues to ratchet higher, 40-year highs in Japan. US treasuries breaking higher, the yields going higher. That means the treasuries are actually in a bearish trend currently. So the BTC spot ETFs came on the scene early January. A lot of fanfare. It has been a overwhelming success in terms of ETF um, growth, the fastest ETF growth in history, with capital pouring into that space this past Friday. Big options expiration with Bitcoin. But since then, and really since the beginning of this spotty BTC ETF, is all about fund flows, and fund flows in and out of markets is really what moves price the last couple of years and continues to be in 2024. You can see from this chart, it's been a steady straight up to the right inflows into these BTC ETFs, X that higher costing GPTC ETF, the grayscale, which money is flowing out of and into so many other names. So Bitcoin has been in my eyes, a commodity like oil, copper, silver, etc. A large extent of what we're seeing here in fiat money failing in terms of the lens of looking through it of hard assets is the continued increase in money supply. This chart here of US M2 money supply doubled in the last 8.2 years. Previous to that, it took 11.8 years, and previous to that, 14.8. So we're doubling money creation at a much rapid accelerated pace. That's why we're seeing this purchasing power devaluation and fiat money accelerate alongside it. I would imagine the M2 doubles in the next phase of this devaluation a lot quicker than 8 years, based on the pace we're on. The trend is your friend. You can see through some charts here and US debt and deficit spending. Basically, no sign in sight of any pullback in fiscal responsibility on either side of the aisle, left or right, no matter who wins the election. You can see it can be said for Canada. Politicians are continue to do what politicians do. That's spend money that's not theirs and spend it tomorrow for the day. That's the main question I kind of ask when I'm looking at asset prices. Will they be higher? Real assets, not fake assets like shares of profitless companies or meme coins, but hard assets, oil companies, real estate, gold, commodities. Are they going to be higher or lower in the years ahead? And the question I always ask is, will politicians spend more tomorrow than they are today? And the question answer is absolutely in my mind. We've seen a massive run up here in cocoa in the last couple of months, really getting a lot of fanfare out there. People who've never paid attention to cocoa as a commodity because it is run up similar to what you're seeing in some altcoins. But we've seen a 10x run up in cocoa back in the 70s after the US dollar came off the gold standard. Looking at the lens of gold back then, though, it did twice as good. It had a 20x performance. This chart here provided to us by SD Bullion. But why couldn't gold do the same thing again in the coming years if this fiat devaluation continues to accelerate? Gold, because of its volatility components, acts more of a currency than it does a commodity. Chart here from the great in Gold We Trust report comes out annually, just out. A lot of good charts in this report. Shows a look back from that historical 1970 coming off the gold standard by Nixon, the bullish run-ups in gold, and then the bearish time periods, the early 80s all the way up to 2000 dot-com crash, that long bearish market. We had another run up into the GFC, pullback, and now we're in shorter market timing of bulls and bears, and this is just an early trend here the last couple of years in a new bull market for gold, breaking out here $2,300 an ounce April 2nd. We're looking through some other nations look at gold as their purchasing power source. United Arab Emirates, Hong Kong, Kuwait, Switzerland, no surprise, big consumers of physical gold. Those rich nations, Singapore, Saudi Arabia as well, and they really value that 5,000-year-old money, which is gold. It's been shown to withstand the test of time to protect your purchasing power. Liquidity of gold, very high as well. So if you're a super high wealth individual and you want to transact in gold, it's a much liquid market more than say Bitcoin at the moment. Bitcoin is still early on the scene though, and it's gaining ground in terms of its daily liquidity, about to surpass UK government bonds. Great chart here from the guys at wowa.ca, WOWA. .ca, give them a follow. They put out some great work when it comes to Canadian housing data, monetary and fiscal data. It's an incredible chart here, which I'm going to show you now in a second, in the next couple of slides, how it's reflective in the debasement of that fiat Canadian currency. So money supply since uh, 2005 it's basically quadrupled to $3.6 trillion as of December 2023. Just incredible. This goal line coming up. Um, so you wonder why your cost of food is basically double in 2 years. Cost of a vehicle is doubled in 20 years is because of this debasement of the purchasing power of that fiat currency, the Canadian loonies. The Bank of Canada has been facilitating this act of money supply growth. Now they've backed off the last little while here on the rate of change slowdown in terms of their quantitative tightening process, but I will imagine this has nearing its end. We're going to go back to quantitative easing in the back half of 2024. Looking at the Canadian currency and its relation to gold over the last 5 years, basically it's up 80% gold is in Canadian CAD. So you put your fiat money, your Justin Trudeau bucks in Canadian hard gold assets instead, you're up 80%. It's done a great job of not only protecting purchasing power, but really giving you some growth in the backdrop of this out of control inflation. Even in the last year, the rapid increase of the price of gold, similar to what we're seeing in the Japanese yen price of gold, the euro, etc. These gold charts all scream to me that it's saying fiat money is dying at an accelerated pace in the last year. To see this kind of a run up in a G7 currency, it's kind of unheard of. It's what you would see out of a Latin American, African, emerging market type nation currency. It's not something I would expect it to see in a Canadian hard currency. Not so much hard anymore. We do not have any physical gold reserves like other nations in Canada, so there's nothing physically backing that Canadian currency at the Bank of Canada. 5-year chart of Canadian bond yields, how this relates back to housing. Most of people look at where mortgage rates are going in 2024, expecting a pullback, some rate cuts ahead from the Bank of Canada. We had that into 2024, into the fall. The market was beginning to price in that there was going to be some cuts coming, but now with this run up here in global growth accelerating and inflation reaccelerating again, the bond market is basically pricing in that there's not going to be extensive cuts in the Bank of Canada's policy decision, immediate term or too many this year in 2024. And then in the last week here, after that was strong inflationary growth prints out of the US, we actually see bond yields rising in Canada. So no let up here in the Canadian fixed 5-year rates, I don't see in the next 30 days or so. June meeting for the Bank of Canada had a 100% probability just back a couple months ago for rate cuts. That one, that's down to 64%. The next meeting after that, it will be in September. It's at 66% of a rate cut. 25 basis points, another 25 basis points. The U.S. similar situation. The U.S. had a 100% probability at its June meeting of a rate cut. Now it's down to 50-50 based on most recent data. So if you've been holding off, purchasing a home or locking in your renewal from a floating to a fixed on your mortgage renewal here in Canada, waiting for big rate cuts, so far that does not seem to be on the rise in short term. Seems like we're on this path for higher for longer, both in inflation and rate pricing higher. So takeaways from the slides here as we start Q2. We have a situation here where the US dollar is gaining strength off the weaker euro, the weaker yen. We also have gold hitting all-time highs along with the US dollar, which you don't often see. They usually move vice versa. Stronger US dollar, weaker gold. But we have a different backdrop happening here where it seems like all the fiat currencies, the Canadian dollar, the euro, the yen, the US dollar, all failing quicker in terms of real hard assets, gold, real estate, commodities. And I think this shift is really starting to pick up pace. It could also be signaling that there's some geopolitical chaos ahead. Maybe there's Middle Eastern tensions continuing to increase, or we're seeing a bid here for oil. But I'm seeing this commodity bounce. Uh, to me, that says we're off some of the lows that we saw in the global industrial recession of 2023 in China, Germany, etc. And now we're gonna, from a rate of change standpoint, go higher, which is a tailwind for higher inflation as well. I'm in the higher for longer camp of both inflation and rates. But we're under this massive government debt umbrella that has to get serviced, and interest on it has to get serviced yearly. And that's become a real issue for the central banks that kind of want to control the money supply and control interest rates and thus currencies. But continuing to watch gold, and I think we're in the next stage of this financial repression, debt monetization game, where basically you're the fiat money, its real purchasing power continues to dwindle. If you're unfamiliar with the Weimar Republic of Germany, it's an interesting book. When Money Dies. Hugo Steins was a German industrial businessman. Became very successful by taking out a lot of leverage, using failing fiat to buy real assets, properties, hard asset businesses, and paid back that failing fiat with less valuable fiat in the future. And maybe that's an idea. None of this here is to be considered investment advice. It's just for entertainment and informational purposes only, as I tried to look at global markets through the lens of uh, how that plays out with real estate. And hope everybody enjoyed that, and would appreciate a subscribe on my channel as I continue to try to put these videos out. Thank you.